Okay, hello all. Today's question I want to move on to is a cash flow statement. Now, I'll start with an ordinary level cash flow statement from 2007, and we'll move on to the higher level questions later. So just one thing to say, the ordinary level cash flow statement comes up as a 100 mark or a question 6 or 7 every year in the ordinary level paper. In the higher level, it comes up as either a 60 mark short question or a 100 mark. And the 100 mark ordinary level question is, I suppose, more similar to the 60 mark higher level question. So that's the one we'll go on to after we finish this 100 mark ordinary level question. So the main premise, I guess, of the cash flow question is that there is a difference between a recorded profit in your accounting records and how much cash your bank has increased by during the year. So just because your trading profit and loss account says that you have a net profit, we'll say, of 50,000, that doesn't necessarily mean that you're 50,000 euros richer after the year. It could mean that you have more than 50,000 of an increase in your bank account, or it could mean that you have less than 50,000 of an increase in your bank account. So we're just going to investigate that. So just to, I suppose, first of all, to take one of the quick examples of why there is a difference between net profit and how much your cash goes up by in the year, we see that there are things that you might spend your money on that might not be recorded in the trading profit and loss account, and the trading profit and loss account being the account you use to calculate your net profit. So for instance, if you're a business that has 100,000 in the bank, and you spend 70,000 on a vehicle, let's say, that is not recorded in a trading profit and loss account. So your bank account will go down by 70,000. It'll go down to 30,000, but there'll be nothing in the trading profit and loss account to show that. It won't reduce your profit by that amount, just because of the nature of how we record certain transactions in accounting. Okay, so there are what we call cash expenses and non-cash expenses, so just one other example before we start this off. There are things like depreciation, annual depreciation, that we calculate on our fixed assets. So suppose you bought a vehicle 10 years ago, and every year you've been depreciating or writing off the value of that vehicle, and you've been writing off, we'll say, 5,000 every year, 5,000 euros. That goes into your trading profit and loss account in the less expenses section, and that gets subtracted from your gross profit, and it reduces your net profit by 5,000. However, it doesn't reduce your bank account by 5,000, because just because you're saying that that car, that van over there is worth 5,000 less than it was last year, doesn't mean you actually pay out 5,000 euros from your bank account. So that's what we would call a non-cash expense. It's recorded as an expense. It reduces your net profit or your operating profit, but it doesn't take any money, any cash out of your bank account or out of your pocket. So that's basically what this question is all about, showing those differences and trying to take that profit figure, if you like, and change it to see what the actual cash situation is and how your cash has gone up or down from one year to the next or one period to the next. Okay. So in the ordinary level, there are 3 things that you're asked to prepare, 3 accounts. A, reconcile the operating profit to net cash inflow. B, prepare a cash flow statement. And C, reconcile the net cash flow to movement in net debt. So for this video, we'll try and just do part A. Okay, just look at what the information they present us with in this question. Up on top here, you see they have a profit and loss extract for the year ended. So that is a very small part of a trading profit and loss account, if you like. It's just the very end of it, in fact. It's missing like a huge chunk, like 3/4 of it, we'll say, up above this section. So it's just an extract because it's only a small portion of a profit and loss account. In fact, the operating profit here that they calculated of 190,000, they don't show any of the figures up above that we used to calculate that 190,000. We can, I suppose, have clues to how they, to some of the figures they used to calculate that 190,000 from the other information that they give us down here. Now, the other information is basically 2 balance sheets. 2 balance sheets kind of compressed into one document. So what it is that they've taken the headings and they have only one set of headings, but for each set of headings there's two sets of figures. One set of figures for the value or valuations on the date the 31st of the 12th 2006, and one set of figures for 2005. Now what I would say is a lot of students get confused or just mixed up as they go along here. Remember, the earlier year is here and the later year is here. Quite often as people go through this, they think of this as the first year and that the year after, but it's the other way around. Just look at the dates, 2005, 2006. Okay, so it's like having two balance sheets there. So you've got a profit and loss extract, a bit of a profit and loss account, and two balance sheets. Okay? So the first thing they ask us to do is this: reconcile the operating profit to net cash inflow from operating activities. So what they're basically saying is, take the operating profit figure that you can get from here, 190,000 is your operating profit from this extract, reconcile it, change it to work out what the actual net cash inflow from those operating activities was. In other words, take the profit figure and change it so you can see what the difference in cash, or the amount of cash that your bank account went up by from doing these operating activities, these buying and selling goods. Okay? So that's what we're going to do. First of all, we need a heading for this document that we're going to create. And the heading is just a rewording of this question here. When they tell you to reconcile the operating profit, the document we're going to have is a reconciliation. Reconciliation of operating profit, so changing of operating profit to net cash inflow from operating activities. So it's basically all of this operating profit to net cash inflow from operating activities, and the only difference is you say here reconciliation of instead of reconcile the, and that gets us our heading. Now, if we're going to change the operating profit to this net cash inflow figure, we've got to start with the operating profit figure, and that's exactly the first thing we put down here. We put down operating profit. Okay, and we get the operating profit from this extract, 190,000 in this case. Okay. And there's only going to be about 4 or 5 lines here, and there's only going to be one column over here as well. And we'll just include the stuff that's in an ordinary level question. There may be 1 or 2 extra lines in a higher level question, but for now, just the ordinary level. Okay, so the operating profit is 190,000. Now, the first thing we're going to look at is, as I mentioned before, depreciation. Depreciation is a non-cash expense. It's an expense that makes your operating profit go down, but it doesn't actually take any money out of your pocket. So when we went to calculate this operating profit in the profit and loss account, we can't see it here now because the calculations were all up here above the 190,000 figure. But we do know that somewhere up here we said minus annual depreciation gives me this figure. So we already took off the depreciation to get to this. But since depreciation doesn't affect your cash, if we wanted to know how much extra cash we were going to have, then we shouldn't really have taken off that depreciation figure. So to undo what we did up here somewhere, we're going to add back on that depreciation plus annual depreciation. Okay, and now, since we don't have the top part here of the profit and loss account, we need another way of figuring out what the annual depreciation figure was for the year. Okay, and what we look at down here is we look at the fact that in our fixed assets here, we have our land and buildings, the cost of them for both years. It went from 850 up to 930, so we must have bought more land and buildings. We're allowed to assume in this case that we didn't sell any land and buildings in this question. At higher level, we'll have to do a bit more work on that, but we're allowed to assume that we didn't buy or didn't sell any. So then we look at our annual depreciation. Well, this figure here is accumulated depreciation. These are the depreciation figures that have built up over the years on all of the fixed assets that we own. And in 2000, on the 31st of the 12th, 2005, that built up depreciation figure was 65,000. And then by the end of 2006, it had gone up to 85,000. So that means the annual depreciation for the year 2006 must have been 20,000 if it went from 65 in that year up to 85. So the annual depreciation must have been 20,000. So we say plus 20,000 to add the depreciation figure back on here. Okay? The next thing we're going to do is we're going to check for increases or decreases in debtors, creditors, and stock. Okay? And there are rules about whether or not we add on or subtract depending on whether it was an increase or a decrease in either of these between the years 2005 and 2006. And I'll talk about the rules in a moment. I think I'll just calculate the figures first and we'll talk about the rules then afterwards. So if we look at debtors first of all, debtors here, it's a current asset. In 2005 it was 36, in 2006 it was 48. So there was definitely an increase between 2005 and 2006, and it's an increase of 12,000. We can see. So I'm going to put 12,000 here. I'm going to call it increase in debtors. Okay, then I'm going to look at the creditors, where our creditors are, again, at leaving cert level, instead of saying current liabilities, we say less creditors amounts falling due within 1 year. We'll talk about that another time, but take this as current liabilities. So creditors in 2005 were 29,000. They went up, or there was an increase in that year to 2006 of 7,000, isn't it? 29 to 36 is 7,000. So I'm going to put that 7,000 figure over here. I'm going to call it increase again in creditors. Now let's just look at the stock figure. And again, stock is a current asset. In 2005, it was 49,000. And in 2006, it was 54. So there was definitely an increase there again of 5,000, isn't that right? So 5,000 I'm going to put over here, and I'm going to call that increase in. Okay, so notice I haven't put a plus or a minus in front of any of these, because now we must decide whether we add or subtract any of these. And I'm going to just tell you, these are rules that you'll need to learn off by heart. It's good to understand why the rules are as they are, but you will have to learn them off just for the sake of speed in an exam, so because you won't have time to be thinking about these things. So the rules are that if there's an increase in debtors, you subtract that figure. Okay, so I'm going to put a minus here, and I'm going to put these brackets to show it's negative or that I'm subtracting. Okay, if there's a decrease in debtors, you add, so the opposite, you add it on. If there's an increase in creditors, you add, so I'm not going to put any bracket over here. Okay, if there's a decrease in creditors, you subtract. If there's an increase in stock, you subtract. So I'm going to put brackets around here to show that that's negative. And if there's a decrease in stock, you add it on. Now, I suppose a way to think about this is, I'll just explain with debtors maybe, and it's pretty much the same for each of the other two as well. If, for instance, there's an increase in debtors, right? It means that debtors are people that owe you money. Trade debtors owe you money because you sold something to them on credit. You sold them some goods, some stock, and they haven't paid you yet. They're sold on credit. So if there's an increase in debtors, it means there must have been an increase in sales. Now, if there's an increase in sales, we know from a trading profit and loss account, that will mean that your gross profit will go up, and in turn that means that your net profit will be higher. Okay, so if there's an increase in debtors, it means an increase in sales, it means increase in net profit. But, however, if you sold it on credit, it means you didn't get any extra money for it because you gave them the stock and you said you can pay me for it later. So, since we increased our operating profit because of the increase in debtors, but we didn't get any extra cash from it. So if we really want to know what our cash position, our true cash position is, what we do is we undo that increase that we had from the increase in debtors by subtracting that amount again from our operating profit figure. Okay, same goes, I suppose, in the opposite way for creditors, because creditors are people that you owe money to because of purchases that you made. So it's the same logic as the debtors, and in a manner of speaking, it's the same as the stock as well. We will go into that further, I suppose, in class, but just for now, you will need to learn the rules, so that minus an increase in debtors plus a decrease, plus an increase in creditors, minus a decrease in creditors, minus if it's an increase in stock, plus if it's a decrease in stock. And the depreciation is always added on, because depreciation has always been, annual depreciation anyway that is, has always been subtracted originally from the gross profit to get to the net profit or the operating profit. Okay, so when we have all that done, what we need to do is add these all up. So 190 plus 20 minus 12 plus 7 minus 5, and that gives us 200,000. Okay, just do a little double line under that. And that is, well, we were reconciling the operating profit, starting with that, changing it to get to the net cash inflow from operating activities. So that must be our net cash inflow from operating activities. Okay, so we're saying that's the cash that we got in from our operating activities. Now, we may have gotten cash in from other things that we did in the business also, or we may have paid cash out from other areas as well. But just from the operating activities, that's the amount of cash we got in. If that had been negative when we had done all our adding and subtracting up here, then it would be a net cash outflow from operating activities. But it was a positive. We have money in from our operating activities.